This is the Regal Imports News for March 2015. A perfect example of missing the forest for the trees. Diamond miners are so removed from the street that they can't see that retailers and consumers are losing the excitement in buying and selling diamonds. Diamond manufacturers are feeling a slowdown and trading markets are flat. There are low expectations for the Hong Kong show, and diamond miners are walking around with blinders and talking gibberish. De Beers is so far removed from reality that they are predicting that they will be able to push rough diamond prices higher in 2015. Are miners just not listening to their customers, or so addicted to statistics that they are losing touch? They expect diamond cutters to survive on 2% margins and still pay good wages, promote downstream projects, and act in accordance with responsible practices. Miners are making money for their stockholders while neglecting the end users, who are the lifeblood of their business. I'll go on record as a frontline soldier in the diamond industry and say that miners are selfish, irresponsible, and lack regard for the future of diamonds as a luxury product. In 2014, De Beers' profits soared by 33% as downstream diamond business suffered. The statistics are out, and U.S. specialty jewelry sales were down 4% last December. In general, U.S. retail is booming, yet diamonds and specialty jewelers are not. De Beers is oblivious and continues to look at stock reports and ignore the changing trends in luxury. There is little incentive for retailers to work for diamond sales. There is simply more margin in moving in other directions. And what is De Beers doing? They are trying to raise prices. Everyone in the business knows that if you want to survive, you must take care of your clients. But the miners have had it so good that they have forgotten this rule. They simply take the health of the diamond industry for granted and are systematically strangling the goose that lays the golden egg. Diamonds are losing the magic. Everyone I talk to feels it. I don't want to bore you again with an analysis. I just want to emphasize this fact. Stefan Fischler, president of the Antwerp World Diamond Center, believes that an over-reliance on technology is removing the magic. He says that magic is only present in the physical encounter between a buyer, a diamond, and a seller. Is it any wonder that in a world of electronic information, that a product that relies on a physical encounter to create magic is losing direction? These days, most retailers sell more paper than dream. Trading diamonds by certificate is a disaster for diamonds as luxury. To quote Fischler again, I call on industry to go back to diamonds and to leave these descriptions and papers more to the side. Let us go back to the magic. We have to change our attitude. I think it is essential." End of quote. In contrast, and back to reality, I have just been informed by a major supplier that if I wish to buy diamonds from them below 70 points, that I need to buy by certificate only. That's right. I need to buy blind. The idea of buying blind is so completely foreign to my philosophy of diamonds and luxury that I'm at a loss for words. Jignesh Mehta, who just opened his 100th retail diamond outlet in India, puts the whole situation in context. He says laboratory certificates provide an analysis of a diamond, but we found that consumers are not interested in analysis. What they want is confidence. Young consumers are bombarded with so many things and are attracted by impressive marketing of products such as watches, phones, and cars. When I see jewelry promotion, it is pathetic. Whatever promotion there is actually kills consumer aspiration rather than building it, because businesses keep telling consumers that the price of their diamond is cheaper than others. For the industry, the most serious challenge is to drive consumers to keep buying jewelry and diamonds. The problem is that the diamond industry is extremely focused on mining and manufacturing. There is very little effort going into understanding consumer behavior and adding value for consumers." End of quote. Diamond laboratories are getting rich not by protecting the public, but by grading diamonds for industry. It is obvious that changing consumer attitudes to appreciate the magic or romance in purchasing a diamond is not going to come from the laboratories that are profiting from the status quo. Gary Holloway, the managing director of Holloway Diamonds, put it this way: "Make no mistake, grading labs are not in the business of protecting consumers. There is little incentive for a market leader like GIA that generates a net profit of more than $100 million a year." End of quote. I said I didn't want to get analytical, and I have covered this topic in depth during previous broadcasts, so I will move on. De Beers' February site saw diamond rough prices reduced by 2%. The Rappaport list has not changed since December, but the discounts below the list are changing. Specifically, I have observed diamonds below 70 points in VS and SI trading at deeper discounts. Even taking into consideration the weak Canadian dollar, it has been necessary to reduce my pricing on these sizes. The lower pricing is due to the GIA reducing the backlog of diamond dossier reports. There seems to be an abundance of these sizes in the market. My market was more active in February. My long-term philosophy is that as long as I can hold my brand value proposition, I will not feel the effects of market slowdowns as much as those dealers that are slugging it out in the trenches supplying pushed grading. I suppose the real challenge to my business and to the diamond business in general will come if more diamond manufacturers decide to trade diamonds based upon certificates without inspection. There are challenges in every business, but a turn in this direction would cause a revolution in my business. Meanwhile, back in the Northwest Territories, the polar bear diamond is in a lot worse shape than its animal counterpart. Their two cutting factories in Yellowknife are still vacant, and the owners, Deepak International, are being sued for $614,000. Examples of how far-fetched the vision of legitimately cutting diamonds in Canada is really evident when considering recent developments in Africa. Diarough has closed their cutting factory in Botswana, and another factory owned by Moti Gans and Leo Schachter are laying off their workers. A total loss of just under 500 cutters. Now, these companies are major international players and specialists in the art of diamond cutting. Leo Schachter was named this year's largest exporter of polished diamonds from Israel, and yet they are not surviving in Botswana. They are moving out of Africa in spite of a perceived contractual obligation to beneficiation. The reason given for the closing of these cutting factories is that they cannot compete with the low cost and high productivity of diamond cutters in India. I have made this point many times over the last 15 years, and here once again is another example of the difficulty of cutting diamonds outside of established diamond cutting centers. It should be blatantly obvious to Canadians that cutting in Canada on a larger scale is impractical, and survival in any area or aspect of this business is illusion and delusional. And that's the Regal Imports news for this month, and I thank you very much for watching.